Listen closely, because what I'm about to say sounds like a satire headline, the kind you'd scroll past, laugh at, and then forget 5 seconds later. But this isn't a joke. This is the kind of "are you kidding me" moment that only shows up right before a major market breaks. While the rest of the world is giggling at memes about buying frozen islands in the North Atlantic, the mood inside the bullion world is absolute panic. Right now, a market that moves hundreds of billions of dollars is being slammed, not by a mine shutting down or a war in a producing country, but by a single political demand involving Greenland. Hidden inside this drama is a sentence that effectively rips the plumbing out of the Western silver market. Today is Sunday, January 18th, 2026. I'm John A.G. If you value original research and real effort, hit subscribe right now and drop a comment that says OG John AG so the algorithm knows who's really riding with us in the fight against copycat channels. Also, check the description for the premium WhatsApp channel and membership links for deeper breakdowns. The trigger, a live grenade in the plumbing. Here is the math problem the headlines are ignoring. A 10% tariff on imports from a list of European countries, including the United Kingdom, is set to begin February 1st. And if the Greenland deal doesn't happen, that tariff threatens to jump to 25% by June 1st. To a normal person, that's politics. To a risk manager at a major bullion bank, that is a warning label on a live grenade. The global silver market relies on one simple assumption: an ounce is an ounce, regardless of where it sits. Traders call this fungibility. The system pretends location doesn't matter because the big players can move metal between hubs whenever they need to. That flow is the oxygen of the system. Without it, the market starts choking. The two lungs of the Western world are London, LBMA, the center of physical wholesale, and New York, COMEX, the center of futures pricing and paper leverage. For decades, banks have played a game of whack-a-mole between these two. If demand spikes in New York, they fly bars in from London to cool the fire. If London looks thin, they pull from New York. The public sees a stable price and thinks the market is healthy, but insiders know it's a constant, desperate juggling act. The wall in the middle of the ocean. Now imagine building a wall in the middle of that juggling act. That is what this tariff does. If the UK is hit with a 10% tariff, anything shipped from London into the US carries a 10% cost penalty at the border. At $900 an ounce, a $9 per ounce penalty. That isn't just a fee, it's an executioner. It kills the arbitrage profit, destroys the swap economics, and wipes out the flexibility the entire paper system depends on. On this Sunday morning, before the markets even open for the week, risk teams are already making the call: stop moving metal. If you export silver out of the US into a tariff jurisdiction, you are gambling that you will never need to bring it back to satisfy domestic delivery demand. If you do bring it back, you pay the $9 penalty. No sane institution takes that gamble when inventories are already tight. London, the besieged city. This brings us to the weak link, London. For years, the LBMA vaults have been bleeding physical silver to the east. India and China have been vacuuming up metal because they view physical silver as strategic inventory, not a paper trade. This drain has pushed London inventories to levels that make insiders extremely uncomfortable. Much of what is left is spoken for, tied up in ETFs, leased positions, or unallocated balances. With the tariff wall in place, New York can no longer comfortably send metal to rescue London. London becomes a besieged city. In commodity markets, when a hub is isolated, prices stop being global and start being local. This is the beginning of a split market. The moment traders realize the metal cannot move freely, the law of one price dies. You could see silver trading at one price in New York and a significantly higher price in London simply because London cannot source the physical metal to meet delivery. This is terrifying for banks because their books are built on the assumption that these spreads never blow out. Their hedges fall apart, and what was a protected position becomes a directional loss.
The Roach Motel strategy. There is a concept called a location swap. Instead of moving bars, banks swap ownership claims. I'll give you title to bars in NY, you give me title to bars in London. This works because everyone assumes the metal could be moved later. The tariff turns this into a trap, a Roach Motel for silver. Metal checks in, but it can't check out without a massive financial penalty. The U.S. essentially becomes a one-way valve. Metal can come in, but once it's here, it gets hoarded. If you are a domestic industrial manufacturer, this might look like supply security. But if you are the global paper system trying to manage a short squeeze, this is a nightmare. Most people think, if silver is trapped in the U.S., doesn't that increase supply and push the price down? That sounds logical, but it ignores the fact that the market runs on confidence. When confidence breaks, price doesn't follow supply, it follows panic. If London shows signs of cracking, the reflex in New York won't be to sell, it will be to buy protection. Banks and funds will rush to rebalance, and that buying pressure can lift prices everywhere. Why the machines won't save you. I want to pause here and point something out. Algorithms are not built for this. Trading bots are trained on interest rates, the dollar, and industrial data. They are not trained to quantify the consequences of a geopolitical real estate dispute on Boolean logistics. The machine sees tariffs as a generic trade variable, but the human sees a pipeline rupture. A wholesale silver bar isn't a digital file you can stream. It requires transport, insurance, customs, and assay verification. When you add a surprise tax that turns a profitable shipment into a loss, you add a variable that traders cannot hedge. The world stops being one market and becomes a collection of smaller puddles with friction in between. That friction is what breaks paper pricing. The silent run on unallocated accounts. Monday morning is when this becomes real. When London wakes up and realizes the rescue line from New York is questionable, we will likely see a scramble, a run on unallocated accounts. Most people don't understand that a huge chunk of silver ownership in London is just IOUs from banks, fractional reserve silver. It works until people lose trust and demand delivery. The moment London traders smell a supply cut, they will call their banks and say, "Convert my unallocated balance to allocated bars immediately." If too many people do that at once, the system cannot perform. When a delivery system fails, it only has three ugly options: delay, settle in cash, or pay a massive premium to source metal. Delays erode confidence, and cash settlement reveals the market is just paper. This is how a liquidity problem becomes a solvency problem. It happens fast, when everyone realizes the exit door is smaller than the crowd. The shift of power, Shanghai as the new anchor. If the physical market in London breaks, the global pricing system loses its legitimacy. At that point, the real price becomes the price where the metal actually moves. If the West can't deliver, the East becomes the price setter. Shanghai becomes the anchor. The East does not price metal the way we do. They have a tighter tide of physical reality and less appetite for infinite paper leverage. A shift in price-setting power can lead to an overnight repricing event, not a gradual drift. I want to hear from you in the comments. If you think the triple-digit physical price in Asia is the true price and the Western spot is just a lagging illusion, comment physical leads. If you think the paper market will win this fight, comment paper wins. Practical advice: stop worshipping spot. If you go to buy physical silver and notice premiums jumping, that is the tariff and logistics effect bleeding into the retail world. If you see out-of-stock banners or longer delivery times, that is stress. While mainstream media is still laughing about Greenland, these signals are your tell. The crowd laughs right before the stampede. Here is your verdict. 1. In a world of trade friction, the safest place for your metal is where you are. Borders are becoming taxes and movement is becoming risk. 2. Stop worshipping the spot price. The number on your screen can be a math error when markets split. Value your stack by its replacement cost. If you sold today, what would it cost to buy it back in hand? 3. Accept volatility as a weapon. You will see moves designed to scare you out. In a regime change, volatility is how the system removes weak hands before the next leg up. The final cliffhanger. The silver market we woke up to this morning is fundamentally different from the one we knew on Friday. The Greenland Tariff has reintroduced the laws of physics and geography to a market that had forgotten them. Here is the question I want you to take into Monday. If the West's silver price is built on the assumption that metal moves freely, and policy just made that movement expensive, what happens to the value of the paper promises that assumed free movement forever? Drop a comment with OG John Ag and tell me which side you think breaks first, London or New York. If you've had a win or a breakthrough in your strategy, share it so the community can learn. Take care of yourselves, take care of your family. I'll see you in the next one.